The image of the American dream built around luxury living is starting to fall apart right in front of us. By 2026, the high-end housing market, long believed to be immune to downturns, is unraveling far faster and more violently than most people ever expected. Cities that once showcased multi-million-dollar homes, where bidding wars ignited overnight, are now overflowing with price reductions, anxious sellers, and massive properties sitting empty and untouched. This isn't about modest houses or first-time buyers. We're talking about elite estates with infinity-edge pools, marble-clad kitchens, private rooftop terraces, and six-car garages. These were the homes that defined success and status. Now, many of them are lingering on the market, marked down by hundreds of thousands, and in some cases, millions of dollars. This goes well beyond a typical market cooling. What's happening is a full-scale collapse in the luxury housing sector. Tonight, Discover the Cities counts down the 10 cities where high-end home values are falling the fastest. Be sure to watch all the way through because the number one city is hemorrhaging wealth at a speed not seen since the 2008 financial crisis. And if you haven't subscribed yet, now's the time. Because this luxury meltdown is just the opening chapter in a much larger housing shakeup, and we'll be breaking down every turn as it unfolds. Number 10. Dallas, Texas. Dallas was once seen as the crown jewel of Texas luxury real estate. High-end homes in neighborhoods like Highland Park, Preston Hollow, and Turtle Creek routinely sold for anywhere between $2 and $5 million, often snapped up before they ever appeared on the MLS. But by 2026, that shine has faded fast. At the market's peak in 2022, the median price for luxury properties, defined here as the top 10% of homes, climbed beyond $1.3 million. Today, those same properties are changing hands closer to $1.05 million. That's roughly a 20% drop in just 3 years. For homes priced above $3 million, price reductions of $500,000 to a full $1 million are no longer shocking. They're becoming routine. The main drivers are oversupply and rising ownership costs. During the pandemic, Dallas experienced a construction surge, with developers pouring McMansions and luxury condos into the market. Now, the result is excess inventory. Homes priced above $1 million are sitting at nearly 10 months of supply, roughly double what's considered a healthy market. Listings that once disappeared within days are now lingering on Zillow for 120, sometimes even 180 days. Taxes add another layer of strain. Property tax rates in Dallas County hover around 2.2%, which means a $2 million home can generate an annual tax bill near $45,000. On top of that, insurance premiums have skyrocketed, often exceeding $12,000 per year due to Texas hailstorms and severe weather risks. Combined, these expenses are pushing monthly carrying costs to levels that challenge even high-income buyers. Investors aren't finding relief in rentals either. Luxury rentals in Dallas typically bring in about $6,000 per month, while total ownership costs often surpass $10,000. What was once marketed as a cash flow dream has turned into a quiet exit strategy, with investors unloading properties, many at substantial losses. Foreclosures, once nearly unheard of in Dallas's luxury market, are now creeping upward. Dallas and Tarrant counties have reported a 14% increase in high-end foreclosure filings compared to last year. Dallas may still project an image of wealth and success, but the cracks are showing. For luxury buyers, the idea of Dallas as a guaranteed safe bet is gone. The city is quickly becoming a case study in how a booming Texas market can pivot into a bust with startling speed. Number 9. Miami, Florida. Miami has long been seen as America's luxury playground. Penthouse views over Biscayne Bay, waterfront estates in Coral Gables, and sleek glass towers lining Brickell Avenue. But by 2026, Miami's high-end housing market is facing its most serious reckoning since the 2008 financial collapse. From 2020 through 2022, Miami transformed into a global magnet for wealth. High-income buyers from New York looking to escape taxes, Californians drawn by sunshine, and international investors from countries like Brazil, Argentina, and Russia poured billions into South Florida real estate. Prices exploded. A luxury condo on Brickell that sold for $1.5 million in 2019 was resold for $2.4 million just 3 years later. Waterfront mansions in Miami Beach doubled in value within 5 years. That momentum has now reversed. Today, average prices for Miami luxury condos are down nearly 22% from their peak. Properties that once ignited bidding wars are sitting idle. A condo that previously sold easily at $2 million now struggles to move at $1.55 million. Waterfront homes originally listed at $5 million are cutting prices by $1 million or more and still remaining on the market for months. The reasons are clear: too much supply and relentless ownership costs. Between 2018 and 2024, more than 20,000 new luxury condo units entered the Miami market, and demand simply hasn't kept up. At the same time, Florida's insurance crisis has turned luxury ownership into a financial strain. Insurance premiums that once ran around $15,000 per year for waterfront homes now routinely exceed $40,000. HOA fees have also surged. Monthly dues of $1,500 are now common in luxury towers, and some buildings charge more than $2,500 per month. Investors who once relied on Airbnb income are backing out as well. Occupancy rates in Miami have slipped below 55%, while nightly rental rates have fallen roughly 20%. Wealthy international buyers, once the backbone of Miami's luxury market, are pulling back, unsettled by high U.S. interest rates and broader global uncertainty. The result is a growing number of empty towers and sellers increasingly desperate to unload properties. The Miami luxury vision, sunshine, skyline, and ocean views, hasn't disappeared. But the market built around it has become overextended, and the dream is now buckling under its own weight. Number 8. Scottsdale, Arizona. Scottsdale earned its reputation as Arizona's premier destination for luxury desert living. Gated golf communities, expansive desert estates, and million-dollar condos tucked against Camelback Mountain became the ultimate status symbols. But by 2026, Scottsdale's luxury housing market is coming apart fast, crumbling like a sandcastle under pressure. Luxury home prices in the area peaked in 2022, when the median reached about $1.2 million. By mid-2026, that number has slipped to roughly $975,000, marking a drop of about 19%. Homes priced above $3 million are seeing routine price cuts of $500,000 or more, and many of those listings are sitting idle for months without serious interest. The core issue is a collision between excess supply and a thinning pool of buyers. From 2018 through 2022, developers went all in on upscale golf community builds, flooding the market with high-end inventory. Now, Scottsdale is dealing with more than 9 months of supply for homes priced above $1 million. Properties that once sold in about 20 days are now lingering for 100 days or longer. Ownership costs have added fuel to the decline. While property taxes are lower than in California, insurance expenses have surged due to increased wildfire and flood risks in the desert. Annual premiums that once averaged around $3,000 are now pushing past $7,500. At the same time, mortgage rates above 7% have dramatically raised monthly payments. A $1.5 million home that cost roughly $6,200 per month to finance in 2021 now carries payments exceeding $9,200. The rental market is no longer offering a safety net. Luxury vacation rentals in Scottsdale are oversaturated, with average occupancy dipping below 50% and nightly rates down nearly 15%. Investors who once relied on Airbnb golf retreats for steady income are now selling at losses. Foreclosures are beginning to surface, particularly in North Scottsdale, where families who stretch to afford $2 million estates are finding themselves underwater. Scottsdale's image as a desert luxury haven is fading quickly, replaced by a tougher reality. High-end living here is no longer the effortless, sustainable investment it once appeared to be. Number 7. Los Angeles, California. For decades, Los Angeles sat at the very center of America's luxury real estate universe. From sprawling Beverly Hills mansions to oceanfront estates in Malibu, LA represented the pinnacle of multi-million-dollar living. But by 2026, that long-standing image is starting to fracture, and for some homeowners, luxury dreams are turning into foreclosure nightmares. The price drops are impossible to ignore. Median luxury home values across Los Angeles County peaked around $3.2 million in 2021. By mid-2026, that figure has fallen to roughly $2.55 million, a decline of about 21%. At the very top of the market, ultra-luxury properties priced above $10 million are being forced to slash asking prices by $2 to $4 million just to generate interest. Several forces are colliding at once. Years of speculative overbuilding created excess supply, while rising property taxes and California's notoriously high cost of living continue to suppress demand. Mortgage rates above 7% have turned monthly payments on $15 to $20 million estates into staggering obligations. In wildfire-exposed areas like Malibu, annual insurance premiums are now exceeding $100,000. HOA fees in gated hillside communities have surged as well, in some cases doubling. The local buyer pool has also thinned. Layoffs across the entertainment industry, combined with declining production activity and shifting tax incentives, have reduced the number of high-earning buyers who once fueled demand. Foreign investors, previously a dependable presence in Los Angeles, are pulling back amid global uncertainty and tighter financial conditions. Rental income isn't offering relief either. High-end rents have stalled, and stricter short-term rental regulations have severely undercut Airbnb strategies. As a result, foreclosures are beginning to surface in places like Beverly Hills and Calabasas. What once seemed unimaginable is now happening. Banks repossessing multi-million-dollar homes from owners who stretched too far. Streets that were once lined with exotic cars now feature price reduction banners instead. The long-standing myth of endless wealth and unstoppable demand in Los Angeles is cracking, revealing a harder truth underneath. Even Hollywood, it turns out, can't script its way out of a housing collapse. Number 6. San Francisco, California. San Francisco was once viewed as the ultimate symbol of West Coast wealth, a place where tech founders and venture capital elites drove prices sky-high in neighborhoods like Pacific Heights and snapped up luxury condos downtown without hesitation. But by 2026, the city is experiencing a full-scale breakdown in its luxury housing market. Luxury home values in San Francisco peaked around $3.5 million in 2020. Today, the median has fallen to roughly $2.75 million, marking a drop of about 22%. The situation is even worse in the downtown condo market, where prices have plunged nearly 30% from their highs. The causes are layered and widespread. Large-scale tech layoffs have sharply reduced the city's population of high-income earners. At the same time, remote work has drained demand for downtown living, leaving once-coveted luxury towers struggling to attract buyers. Ongoing concerns around crime and homelessness are further discouraging would-be homeowners. Cost pressures only deepen the damage. Property taxes on a $3 million home exceed $35,000 per year, while earthquake insurance premiums are now pushing past $15,000 annually. Meanwhile, inventory continues to climb. Luxury condos that once sold within days are now lingering on the market for more than 200 days. Developers who once assumed tech wealth would never slow are now scrambling. To move inventory, they're offering steep incentives, covering HOA fees, throwing in high-end upgrades, and even dangling Tesla giveaways. Still, demand remains weak. Investors are stepping back as well, with luxury rental prices down nearly 18% and returns no longer penciling out. Foreclosures are beginning to quietly surface in San Francisco's most exclusive neighborhoods. Families who stretched to buy $4 million homes during the peak are now underwater, watching values slide further. San Francisco, once considered untouchable in the luxury world, has become a clear warning of how quickly a market tied too closely to a single industry, especially tech, can unravel. Number 5. Aspen, Colorado. Aspen has long stood as the ultimate symbol of exclusivity. Think ski chalets selling for $10 to $20 million, billionaire estates tucked deep into the mountains, and luxury condos priced higher than mansions in most major cities. But by 2026, even Aspen is no longer immune. Its luxury housing market is sliding sharply, shattering the idea that it was ever recession-proof. High-end home values in Aspen have fallen nearly 18% from their 2022 peak. A chalet that once sold for $12 million to a hedge fund executive is now listed closer to $9.5 million. Vacation condos that previously commanded $4 million are trading nearer to $3.2 million. These aren't isolated cases. They reflect a broader pullback in demand. The buyer pool has thinned dramatically. Higher mortgage rates have pushed prices beyond the comfort zone of even very wealthy buyers, while the ultra-elite group of billionaires who once dominated Aspen purchases has begun shifting attention to international destinations. At the same time, ownership costs have exploded. Property taxes, wildfire insurance, and steep HOA fees in exclusive ski communities now add hundreds of thousands of dollars each year just to hold a property. Investor demand has taken an especially hard hit. Stricter short-term rental regulations have crushed the Airbnb math, with rental income down more than 25%. Revenue streams that once justified 8- and 9-figure purchases no longer make sense on paper. As a result, luxury homes are lingering on the market for more than 200 days at a time. Foreclosures remain uncommon, but they are starting to appear, an alarming sign in a market once viewed as untouchable. Even in Aspen, some over-leveraged buyers are being forced to walk away. The illusion of Aspen as a safe haven for endless wealth has been broken. Its downturn is proof that when the numbers stop working, even America's most exclusive luxury markets can unravel. Number 4. The Hamptons, New York. For years, the Hamptons represented the ultimate summer escape for Manhattan's elite, a place defined by exclusivity, prestige, and seemingly endless demand. But by 2026, that image is starting to unravel. Luxury home values in the Hamptons peaked around $3.2 million in 2021. Today, the median has slid to roughly $2.6 million, an 18% decline. At the very top of the market, ultra-luxury beachfront properties that once carried $20 million price tags are now slashing $3 to $5 million just to attract interest. The downturn comes down to two forces colliding: oversupply and crushing costs. During the pandemic, wealthy New Yorkers rushed east, triggering a wave of new luxury construction. Dozens of high-end homes flooded the market in a short period of time. Now, the Hamptons are sitting on nearly 12 months of inventory. Properties that once sold within weeks are lingering for 180 days or longer, waiting for buyers who are no longer rushing in. Owning these estates has also become dramatically more expensive. Property taxes on an $8 million home can exceed $120,000 per year. Insurance costs for hurricane and flood risk have surged past $50,000 annually. When you factor in full-time staff, groundskeepers, security, housekeeping, and maintenance, the yearly carrying costs for a luxury Hamptons property can easily reach between $300,000 and $500,000. Rental income, once the safety net, is no longer providing relief. The short-term rental market is saturated, with weekly Hamptons rates down nearly 25%. Investors who counted on renting to Wall Street executives during peak summer months are now bleeding cash instead. Foreclosures, once almost unheard of in the Hamptons, are beginning to surface. Banks are quietly repossessing multi-million-dollar estates, a development that would have been unthinkable just a few years ago. The Hamptons' dream, built on scarcity, status, and perpetual demand, is quickly turning into one of the most painful luxury housing busts on the East Coast. Number 3. Las Vegas, Nevada. Luxury real estate in Las Vegas has always leaned into spectacle. Think million-dollar penthouses overlooking the Strip, oversized mansions with infinity pools, and hillside estates built to make a statement. But by 2026, that high-gloss image is cracking. The luxury bubble in Las Vegas has officially burst. Luxury home prices peaked in 2022, when the median hit about $1.1 million. Today, that figure has fallen to roughly $880,000, a decline of around 20%. Homes priced above $2 million are being forced to cut asking prices by $400,000 to $600,000, and many are still sitting unsold for months at a time. The collapse comes down to familiar forces: too much supply and rising costs. During the pandemic boom, developers flooded the market, convinced demand would never slow. Now Las Vegas is dealing with nearly 11 months of inventory in the luxury segment. At the same time, mortgage rates above 7% have sharply reduced affordability, even for high-income buyers. Owning these properties has also become far more expensive. Property taxes on a $2 million home now exceed $20,000 per year, while insurance costs tied to desert flooding and wildfire risk add another $7,000 annually. Monthly ownership expenses that averaged around $6,000 in 2021 are now pushing closer to $9,000. Rental income isn't providing a lifeline. Luxury Airbnb bookings are down about 20%, and an oversaturated vacation rental market has left many units sitting empty. Investors who once relied on non-stop tourism demand are now rushing to offload properties. Foreclosures are beginning to rise, even in upscale communities like Summerlin and Henderson. The Las Vegas luxury fantasy, built on glitter, glamour, and the promise of endless demand, is fading quickly. Beneath the neon lights, financial stress is spreading, and for the first time in decades, Las Vegas isn't selling a dream. It's selling losses. Number 2, San Diego, California. San Diego was long viewed as the quieter, more refined luxury alternative to Los Angeles. Beachfront estates in La Jolla, dramatic cliffside homes in Del Mar, and high-end condos overlooking the harbor defined a market built on understated wealth. But by 2026, that image is breaking down, and San Diego's luxury housing market is sliding fast. Luxury home prices in the region peaked around $2.4 million in 2021. Today, the median sits closer to $1.95 million, reflecting a decline of roughly 19%. At the very top of the market, ultra-luxury properties priced above $8 million are being forced to cut asking prices by $1.5 to $2 million just to attract attention. The pressure points are clear: rising costs and growing oversupply. Property taxes alone on a $5 million La Jolla estate can exceed $55,000 per year. Insurance premiums tied to wildfire and flood exposure have surged past $25,000 annually. On top of that, mortgage rates above 7% have driven monthly payments from roughly $12,000 in 2021 to nearly $18,000 by 2026, dramatically narrowing the buyer pool. Inventory is also stacking up. Luxury homes that once sold quickly are now sitting on the market for 150 days or longer. Sellers are cutting prices, offering incentives, and even including luxury vehicles in deals, but buyers remain hesitant. Rental income isn't providing a fallback. Demand for high-end vacation rentals has dropped sharply, with average occupancy falling below 50%. Rents that once comfortably covered carrying costs are now coming up about 25% short. As a result, foreclosures are quietly beginning to appear in some of San Diego's most exclusive neighborhoods. Families who stretched to purchase $3 to $5 million estates during the boom are now stuck, watching their equity evaporate as values decline. San Diego's luxury dream isn't fading because the city lost its appeal. It's collapsing under the combined weight of high costs, excess inventory, and a shrinking pool of buyers willing or able to pay the price. Number 1. New York City, New York. For decades, New York City stood at the very top of the global luxury housing world. Penthouse apartments overlooking Central Park, classic townhouses on the Upper East Side, and sleek glass towers rising across downtown defined the ultimate symbol of wealth. But by 2026, New York City is facing one of the most severe luxury housing downturns in modern history. Luxury home prices across the city peaked around $4.5 million in 2020. Today, that median has dropped to roughly $3.55 million, representing a decline of about 21%. At the extreme high end, ultra-luxury penthouses that once carried $50 million price tags have been forced to cut $10 to $15 million, and many of them are still sitting unsold. The forces driving this collapse are overwhelming. Years of overbuilding, particularly billionaire-focused condo towers, collided with crushing taxes and relentlessly rising costs. Property taxes on a $10 million condo can reach $200,000 per year. Monthly HOA fees routinely exceed $5,000. Insurance premiums continue to climb, and mortgage payments on $20 million properties have reached levels that even the ultra-wealthy are questioning. At the same time, demand has dried up. Wall Street bonuses have shrunk, international buyers have pulled back, and remote work has weakened Manhattan's long-standing gravitational pull. Inventory in the ultra-luxury segment has ballooned to nearly 14 months of supply, a staggering figure for a market once defined by scarcity. Rental income isn't providing a safety net. High-end rents have softened, vacancy rates are rising, and entire luxury towers are sitting partially empty. Investors are quietly unloading properties at losses, and foreclosures are beginning to creep into Manhattan's luxury market, something that was once considered unthinkable. The skyline that once symbolized limitless demand now tells a different story, with darkened glass towers standing as reminders of excess. New York City's luxury crash isn't just a routine correction. It represents a generational destruction of wealth at the very top. From Dallas to New York, from Miami to San Francisco, the luxury housing dream is unraveling nationwide. Price cuts, rising foreclosures, and disappearing buyers are sweeping through America's wealthiest markets. The long-held belief that luxury real estate was immune to collapse has been completely shattered. This downturn may be even more significant than 2008, because this time the damage isn't centered on Middle America, it's hitting the very top. If even these elite markets can fall apart, the question becomes unavoidable. Who's next? This is Discover the Cities. If this breakdown gave you a clearer picture of what's really happening, hit subscribe so you don't miss what comes next.